I'm Jeremiah Boucher, a commercial real estate investor with over 20 years experience. This show is designed to help you build your business, become a better real estate investor, and help you see opportunities that will keep you ahead of the competition. This is Finding Your Edge.
So what I wanted to focus on this year is one needs to look at as the investor, thinking, okay, what asset allocation do I have in my portfolio? Because this is what the ultra wealthy do. This is what the big funds do. This is what family offices do. Where am I allocating what assets that I have? And this is based on personal goals and how aggressively you want to grow or how you want to create cash flow in your life. And then the second thing is portfolio management is, do I want to shift that? Do I want to be more in cash right now? Do I want to be all in all my real estate assets because I'm adding a ton of value and I know those are going to double or triple in value in the next few years? Do I want to have some equities and stocks? Do I want to be in fixed income with CDs and some safe, just secure bets where I'm going to get some nice interest income over time? So I've been going through all 100 assets and looking at every single asset, looking at the data. And that's really important for us, is having that trailing 12 profit and loss performance and seeing the trends. And we're seeing trends where we're getting in front of it, where the income's tailing off a little bit with storage. So you're not having that growth right now, and need to know that when you're looking out in the marketplace and buying, that you can't expect that growth's going to just pop right up on your revenue side because the consumer's tight right now. I think 2023, there's going to be a more aggressive recession. We'll see where that goes, and no one can tell the future. And then on the other side of it, the asset itself is, where's our debt right at? And how good of a position are we where we're playing a little bit of defense? Because some of the assets aren't fully stabilized. And this is a dangerous game, because in real estate, all the returns come from leverage. So when you're borrowing on these assets and they're not fully covering the debt, or they're tight in terms of being able to have that net income cover the debt, if you're not in that position, you got to use additional resources outside of that investment or that asset to actually keep that afloat. So it's tricky, man.
It's very tricky
to plan and strategize.
It's tricky, but it's critical. And one of the things you said, like we were just talking about offense, right? Offense, acquiring, how are we lead generating? Great. But then the defense being, what do we have? And then how, even more part of that is, I would think you'd agree, would be like your tax strategy, right? Your tax, what's that look like? And very exciting news. I don't know if we can talk about it, but you actually have a book coming out kind of to really talk about that. So why don't you get into that a little bit? I'd love to hear more.
Yeah. And offline, we talked about your tax strategy last year, and I kind of called you out on, there was some things that you could have done to be more prepared personally, so that your personal investment portfolio, that you were able to keep more of that net income at the end of the year and go reinvest it and pay those taxes down the road, rather than get the government to take that big cut. And then, that money you can't put to work anymore. So the next book is called The Money Edge. It's the tax strategies that you don't know about, that the wealthy do know about. And it's all about maximizing the tax strategy of commercial real estate. And I'm a big proponent that these strategies are simple and clear, and that it doesn't need to be complex or complicated. Now, there's a million different nuances and IRS statutes and codes that do back all this stuff, and there's interpretations to it. But at the end of the day, some financial advisor or some tax advisor doesn't need to talk over you where you don't understand these things because this isn't your primary business. That doesn't have to be the case. Right. The rules of the game are still very simple. We're not doing advanced calculus or physics. It's basic business 101. So what I wanted to break down is, I had my tax advisors and my CPAs with our publishing company, and me being in there with a series of interviews over the last 12 months, where we not only came together and put the 5 or 6 tax strategies of how to build a real estate holdings company, but also back it up with the actual IRS statutes and the different case studies and interpretations of some of these laws. So I feel confident. I didn't want to put out anything, one, that jeopardized my reputation. And then 2, I want to be able to share with investors, if your goal and ambition is to grow as a real estate investor, which I think it is, right? That's the formula of wealth. Earn a lot of money through a business or a skill, and then invest in real estate. Everything else is speculation and betting. That's just my personal opinion.
No doubt.
The stock market is just a big fucking casino that is just legitimized through the markets, through a bunch of advertising where broker dealers and everyone else gets a bunch of fees. And you're
it's a big party. It's a big party, but I'm not invited. It's a big party that I'm not invited to. It's a select few.
Exactly. And not to go off on the tangent elsewhere, Marty, but I just finished that Madoff documentary on Netflix, the 4-part series.
Oh, wow. How was that?
It was excellent because it just goes to show you he was the only one that did serious time. And then he had maybe a handful of people outside in his organization that did some time. But it was literally like less than 5 or 10 people that did time for that. And it was a $64 billion Ponzi scheme, which actually it was $19 billion at a cost basis. He marked everything else up like they made the rest. But what I learned from that is a lot of things. Is one, the psychological tactics he used in order to get people to want to invest more by taking away the ability for them to invest, and then using his status with other people that they thought, oh, wow, this person did it, so I need to do it. And then he would continue to refuse them and they would continue to want it even more. But the bullshit around that, oh man, it was something, a financial sociopath. What was crazy about that is that there's no way he could have raised $19 billion without the complicity of all these feeder funds, where these fucks in Wall Street took all this money, did zero due diligence. This guy was he was fabricating shit on dot matrix paper, sending out statements 2 weeks to a month after the fact that the trades he said were made. And he would always change it enough so that it looked like he was ahead of the market, or he exited the market right before the stock went down. And these feeder funds all over globally made so much money on the fees that's the premise of how this shit continued to just skyrocket. Is all these people don't give a fuck about the investor at the end of the day. So when you're watching the last episode and these people are crying because they lost their entire life savings with their family, because this happened for 40 years. So their grandparents and their parents put money in this fund. And then at the end of the day, there was nothing left. That you look at it and it's like, yeah, it's tragic. I feel bad about that. But, if you put your money in this and you really didn't look deeply at it and you didn't do the homework, or you allowed yourself to think that there's something that's too good to be true, or there's just a part of it where, you didn't really do your homework about it. And then it's gone. And then you trusted some guy that's just pushing a stock because he gets a commission. It's just human nature, man. So I feel like there's more that we could talk about on this, but it really opened up my mind that I don't want to be this guy that anytime I'm in an investment where someone makes a lot of money from me and they have no liability, they have no aligned interest in this thing that they're selling, right away, I have no interest in investing or working with that. You better be in it for the long haul with me, and you and I better align, and you're going to lose everything. If I lose, you're going to lose.
Yes, 100%. And you know what sucks about it is obviously the damage and all those things that you can't come back from. But look at what happened with FTX. It's the same thing.
Yeah.
Like you have all these paid spokespeople that you think you can trust, like Kevin O'Leary or whatever. But the biggest problem is that these companies, they're not doing their due diligence. They're not doing their research. And that gives small guys like us a bad kind of rap. It's like, hey, well, it's already a skeptical kind of thing. It's like the last thing that we need is more fucking shit that's going to cause it to be skeptical. It's like, listen, I'm like, you guys you put money into your deals and it's like, no one cares more, right? Like no one cares more about the deal than me. Nobody wants the investor to win more than me or like you. And it's like the last person that typically wins in these, like you were saying with the Wall Street and all that crap with the stock market, is the retail investor. The retail investor doesn't win. It's a scam. And so you're completely right that real estate truly is the only, I shouldn't say the only, but it's the longest standing form of an investment vehicle where somebody like an immigrant that comes into this country can buy a couple properties and be a self-made millionaire. You can't do that with the stock market as somebody that's coming here with nothing, right? But you can come here and buy that property and start cash flowing it through maybe buying a duplex, and boom, you upgrade that because you bought a fourplex and you upgrade that to a 16. Like that's the beauty of real estate. And I think more people need to know about it. And I'm glad that we can talk about it.
Hell yeah, man. That's spot on. Well said. That is it. And I'd rather right now make a 1.5 or 2x on my money over 5 years. And it really wasn't a monster return. I mean, well, 2x is not bad, but you're able to do that and preserve the cash and keep growing it. And you didn't pay taxes along the way. You deferred them off. You got to keep that in mind.
Yep.
Versus all the speculative shit I did where I put money in deals through crypto or through
Right.
oil and gas or through different alternative investments and even real estate. Certain speculative real estate deals didn't work out. You look at the portfolio at the end of the day, I was analyzing even some of the crypto shit I did. I got in early when $500 or $1,000 a coin in 2015, 2017. But over time, as you chase it, I looked at the overall and I'm down 50 grand. It's like I always up and in my mind. And then you look at it all and you're like, oh shit, like I'm not up at all. But the mental, like as investors, just like the gamblers in Vegas, you talk about the wins, but you don't talk about the losses.
Right.
And when you look at the end of the day, you really didn't have much of an edge at all. You actually lost, but you don't, until you see the hard numbers, you don't acknowledge them.
100%. Agree. I'm looking at my crypto portfolio and you scratch your head and you're chasing. That's what it is. At the end of the day, you're just chasing. So
good
call.
Well, I'm not saying storage is the end all be all or mobile home parks or apartments or any of these asset classes. I mean, they all have their challenges. They're all a business that you have to run and operate, and you have to work within different economic conditions. So, but I do believe what you said is that you put a foothold in these assets and you do the right things. And over time, if you can weather the storms, you're going to be really well off over time. And that's what I think all our listeners are that's what they're focused on. That's why they're here. That's why we're here. And we're trying to get better at that.
Yes.
So the book to really hammer it home. And what I want to do is give a playbook or blueprint to create your real estate holdings company. Number one is just to maximize the tax effect of real estate. So instead of having a few unorganized real estate investments here and there, you have everything under your own partnership. And if it's going to be a family partnership or an individual partnership, now you have all your investments feeding into one company, one entity. And that's going to create some benefits for you where, number one is you can treat yourself like a real estate business. So even if you are working another job or you have other businesses, from there, all your real estate activities, if you're traveling, if you have education, if you are spending money on your office space, any of these things, that offsets some of that income, that net income at the end of the year, where you're not paying tax on that. And you shouldn't, because that is a legitimate business activity and you're treating it that way. Secondly, you got to create an estate plan so that you do have liability protection where, in this litigious society, when people go after you personally, if something were to happen in your business or personally you do something stupid, having the right insurances and the right legal protection in place, that is important. And it's until you acknowledge that, wow, I actually own some things, I need to actually protect them, but you kind of forget about it. And that's something that for me, I never really cared about because I didn't have anything for a long time. And then as I have more things, you got to protect it.
Absolutely.
Yeah, it's very important. So the rich don't really own anything personally. They own things through entity after entity. And at the end of the day, they control a lot of assets, but they don't own the assets. They control them and they get that money through a lot of various techniques.
You were saying this on a video that you were doing, and I was fascinated through learning more about like the trusts and the members and of the trust that can be fired, and then no one really owns anything. It's like some sort of complete game, which really just stops in my head. It just stops in a lawyer trying to find out what does this guy really own or girl own or company really have, and then they're just like, hey, listen, it's probably not worth it. They have their stuff pretty much buttoned up. But I thought that video was really good that you had. We'll have to link that video to this, so you guys can see a little bit more. It was a quick clip that Jeremiah did, but it was really impactful. And that's probably a little bit more we're going to get in that book, right?
Oh, for sure. Yeah, you're going to hear about it because estate planning is the next piece. And I don't have a big family, but if you do pass, why have to go through probate? Why get all the fees to dilute out all your equity? And it creates a lot of tension and creates a lot of drama in the family where people are already distressed emotionally. And if you can't transfer those assets to the people that you want, why leave that legacy? It's brutal. So
I was actually saying that on a video I was doing. I was like, don't be someone else's deal, right? Don't be someone else's deal where there's distress and there's a family problem. And now they just want to fire sale it because they don't know what to do with this thing and it wasn't set up properly. Like, make sure there's an actual game plan. Let your family know about, hey, this is something that I have, and make sure that it's communicated. I think a lot of people don't talk about it because it's money and there's value and there's some whatever nuances you might have with your family. But yeah, don't be someone else's deal here, right?
Yeah. Oh, yeah. And that starts once you have your holdings company and you look at your real estate investments or any investment that you have as a business, you need an advisory team. And it's not expensive, and you don't need New York guys or LA attorneys or anything. You just have to find people that are aligned with our philosophy. And number one, you need an accounting or tax strategist that understands what we're talking about in here, the tax benefits of real estate and how accelerating depreciation and using some of these losses that we're allowed to use can offset any of your passive income or all this rental income that you're getting in this company over time, where you might be small in the beginning, but if you structure it the right way, you're not paying tax on a lot of these distributions. And that's what the game's all about. And your second thing is you need the right legal advice and these people aren't just going to put it to you on a silver platter. I mean, most times they're going to look at your situation. They're going to give their professional advice from their perspective. And any carpenter with a hammer is going to want to use his hammer. But you might not need a hammer. You might need a screw and a drill and a lot of other tools. So giving the insight into these are some of the different techniques. And if you want to achieve this, and this is why, you got to advise your advisors. And we recommend some advisors. So the legal structures in terms of, you really need to make sure you get the right entities that you hold these assets in and the right agreements, the operating agreements or the trusts and wills, in order to make sure that these assets are protected in a way that you're safe and your family's safe, and that you're going to maximize whatever comes out of these assets. Because the golden ticket, the premise of all of this stuff is having this nice, consistent distributions coming out of these assets, where when you're long and done with whatever skill or craft or business you were doing personally, right, we're all in this to get these nice monthly, quarterly distributions where our assets work for us. We don't work for money or assets.
There's two things on that, right, that you were just talking about that I took. And number one is some of the stuff that you were saying, I'm not familiar with, right? So, and that for a lot of people listening probably is the same case. And that seems scary, a lot of those things. And if that is the case, which it is for me, all that means is I just need to be better educated. That's why I can't wait for that book, right? That doesn't mean stop. That doesn't mean, oh God, this is not for me. This is way too complicated. No, it just means I'm excited to now learn something new. It was exciting to learn the acquisition part of this of this side of my business, and hiring and fun things like that I find enjoyment in. This is not that quite, like, doesn't resonate with me in that level, but I know how important it is. So I can't wait to really learn that stuff, because I don't want, like you were saying, this shouldn't be something where it scares you. It shouldn't be something where you have like a personal finance person who is really just trying to sell a certain thing that they're being jammed down their throat from their management to get to you, like where they're just trying to get the fee or whatever it is. You got to know this stuff. They try to overcomplicate it because they want you to feel like it's overcomplicated, but it's really not. After you really look at it, that's why this book is going to be such a great resource. And the second thing that you said is, the team that you surround yourself with, right? The CPA, the attorney. And it's something that I'm thinking about as this business is growing for me, is that, and I'm sure maybe this happened to you, is that the people that got you from a single family renter flipping guy, right, may not be the same people that get you to, and you know what I mean? And so that might be tough. Just like the owner of Oracle said, the same people that took me to a $3 million company that were in my management and upper management weren't going to be the same people that took me to the 30 million. And that was the toughest decision I had to make. So these are really good conversations, and these are great things to be thinking about.
Oh yeah, man. Definitely. And do it now before you have to unwind some things that you don't want to. You made a lot of mistakes to get there. Yeah, I think having that perspective and some confidence, because you have a reference and understanding of the macro kind of things that you want to achieve, are going to give you, it's going to eliminate fear. And that's what I want to get across. And then when you can look at your family situation, where I have a lot of investors that are plastic surgeons or dentists or business owners, and one of the spouses aren't working, or they're lightly working, or they're looking at all the real estate, or they're managing the family's real estate rentals or different activity that the family's investing in, is really maximizing that amazing rule where you can, as a real estate professional, be able to offset a lot of the losses from real estate. You're able to offset some of this ordinary income, or also called earned income, from the other party. So you guys can be a powerhouse marriage, a powerhouse couple, where that you have this family real estate holdings company, and the spouse, typically sometimes the wife, they'll manage this real estate holdings company. And I'm not saying they need to be a realtor and go out and sell houses, but they can asset manage, where they're deciding, are we going to buy or sell this? Are we going to, what's going on with our property manager? Who's filing the taxes? Where are our quarterly reports? Let's go look at the property again and make some notes and talk to our partners about this. Do we, are we going to buy this rental here? Or do we sell this rental? All these decisions that they make overseeing the portfolio takes time. You own just a house or 5 houses, or if you're partners in buildings.
Yes.
So this side of your business can create a lot of passive losses, these coveted losses that the wealthy play in, where if they're buying equipment in their company, or if they're buying real property, anything outside of land on your real estate, you get this allowance to this expense. You get this expense that's not a real tangible expense, but on the IRS's eyes, you're allowed to create this expense. And then if you have a lot of profit through your real estate income activity or through your business activity, you can create all this depreciation that it can flow through. If there's additional losses, it flows through to this side, where the other partner is working his ass off, generating a lot of revenue. Like my dad has a paving company. He's generating revenue through here. There's a profit at the end of the year. Other guys that I know that are doctors, they have but if the wife over here is investing and putting this time in, and they're doing the right things, having the 750 hours of qualified real estate activities, and they're able to do that because they have everything in a holdings company. So anything that they touch in that holdings company gets to qualify them for those hours that they met the designation of the IRS. Then on the other side, the husband or the earner in the company, the ordinary income earner, the wage earner, or the 1099 earner, they're not paying tax. And that's huge, right? If you're working your ass off and you're generating $2 million a year in earned income, or $1 million a year, at the end of the day, you've been making the right investments for your family, where they're in the 38% tax bracket or 40% tax bracket with federal and state. Then you're not cutting out $400,000 or $800,000 of taxes. You could go in there and invest that money back into your real estate holdings company, offset the entire $400,000, or at least a majority of that. And now you have assets that maybe they pay you only a 2 or 3 or 4% yield in the first few years, which is just a very poor return. And there's better returns out there, but say that's all they pay. But over the life of the investment, those assets double, triple, quadruple in value. And then when you do sell them, you pay tax. We're not doing evasion. This is tax deferral. And then you're compounding money, baby. That's the name of the game.
So that was very enlightening. And for a couple reasons, is because I feel like if you know that part, the first part's important, but I'm going to change my whole script. That's more important. It's more important because why? Here's why. Because you can talk the talk. You think, just because you make a lot of money doesn't mean you understand this at all. Just because you're a doctor or a dentist or a lawyer or whatever it is, where you're a high income earner, you think, well, you're a wealthy person. You understand this. No, you don't. You do not. And if you can, and you can explain it like you did, you will have never, ever a problem raising money to put into a deal. That makes sense, obviously, because you're running the first part correctly. Love it, Jeremiah.
Oh, there's money on the table, right? I mean, it's not like, with this person, you make $1 million, you worked hard. A lot of these guys went to medical school, and they're paying off their debt. They have a lot of competition. They have a lot of insurance because they're afraid of getting sued. They got to this point where they can earn millions of dollars a year. And there's the other side of this where they get stuck in this traditional investment mindset where they give their money to a money manager. Even if the stock market did 8, 12, 15, 20% yield on this capital, they're still getting taxed on it, and they're still getting taxed on all their earned income. And I'm not saying that every single person needs to have their wife or their spouse become a real estate professional. I mean, who knows where this is going to go? But if the case is that the family can afford to do that. It's something that you should at least know the option, right? So that you can decide as a family how you want to really grow in your portfolio, and you're doing it as a team. It's just an option. And that's an important thing to understand. So you have no choices.
And that's just how powerful real estate is. That explains it right there. This is why you'd want to buy it. This is why you want to partner in. This is why you want to do with real estate. It's got to be real estate. If you are a high income earner and you don't have any real estate, you are missing out completely, because you're trying to go with just what they want you to do, which is put your money into this thing. That's the stock
Wall Street machine.
Yeah, that's what they want you to do. They don't want you to understand.
Yeah.
They don't want you to be educated on this stuff. They don't want to. That's why the book's so important. That's why all this is so important. That's why what we're doing is important, because that is what we're doing. We're telling people, we're spreading the gospel, the good news of this stuff. And the key, though, is being able to say it in a way that people understand. And just that alone, I think, will blow people's socks off. Just knowing that's an option. I didn't know this was an option. It's great.
Yeah, and the beautiful thing is that when people talk about taxes, and Rich Dad Poor Dad and Robert Kiyosaki's the grandfather of this, he really put it on the map for all of our generation right now. And it was, what's the difference between rich and poor? And the whole premise of everything he wrote was it's the way they think. And the way they think, the way that I understand it, is what is your association to some of these important topics around money and business? And poor people are fearful. They associate a lot of fear. When my family growing up talked about money, or my father would talk about business strategy and how he would approach taxes, it's just initial. It's that East Coast deal where it's like, I brought it to the accountant. He told me I had to pay $200,000 in taxes. That's what I'm going to do. And I don't want to mess with that, because I don't want to get in trouble with the IRS.
Right.
And it's complete fear around it, where that disempowers even the idea of how could I do it differently, and how can I create my company in a way that I don't need to pay these taxes right now.
Right.
And I get it. So the philosophy around this, Marty, in 2 minutes, is the tax system in America is a system of incentives. So there's a reason why the IRS is doing what they're doing. And I know people hate government and that they think there's no rhyme or reason to what's going on. But no, there's corporate interests and there's interests that create why this system is in place. And I'm not saying it's good or bad, left or right. I don't give a shit about any of that. I'm just playing the game the way it's structured. And the reason the game is structured this way is, number one, is in a free capitalistic society, you have to be able to put money and reinvestment into infrastructure. So you have to be able to build houses. You have to update buildings. You have to continue to improve real property, real estate that we all use day in and day out. And if you don't incentivize the wealthy or the capitalists, the actual entrepreneurs and the investors in your country, then you get dilapidated, fucking torn to pieces, go to third world country type shit, where you don't have an infrastructure and there's no incentive for the investor to put the money back into the real estate so that the people can actually use it. So these tax incentives might be used where initially you're not really taking that cash and reinvesting it in improving the property, but over the life of the asset and over the life of your investment firm, yes, you're going to continue to play the game where you can buy and improve the property out of selfishness and self-interest. But that is actually improving everyone around you, because there's a large incentive for you not to pay all that tax and for you to go buy more real estate and do those improvements to maximize your rent and maximize the tax liability. But the government's not going to do that. They don't go out and build housing for people. They don't go out and build all these office buildings and apartment buildings. So that is the depreciation incentive does work. It does create investment back into real estate. And then secondly, the richest people in the entire global financial system, and I believe in it 100%, is the banks. Because whoever controls the money, whoever owns the gold makes the rules. That is capitalism 101 in the way that we have this fractional reserve banking system. And there's nothing wrong with it. It does create inflation, and I've thought a lot about it, and it's fine. It creates the liquidity that we all need to trade and to exchange value back and forth. And who knows where it's going to evolve to. But at the end of the day, the incentive to write off interest. That is a tax advantaged expense. So getting into debt, you're incentivized. And then secondly, for you to be able to actually borrow more money and take money out of these assets every time you refinance, you don't pay tax on that money. That's tax-free. You're paying the banker that interest. There's this underlying idea or this underlying incentive that putting leverage on these assets is exactly what's needed to be done in order to maximize your return and to maximize your tax liability. And so you can continue to buy up and buy bigger assets, not to offset or not to pay taxes. So these incentives by the government to grow and reinvest into more real estate, to borrow to buy more real estate, to borrow to offset your expenses because you're paying interest, to borrow because you're able to take cash out of these assets and go buy more assets or put it back into the property. These are the structure keeps the whole machine going.
Right.
So we're going to play this game. Yep. We're not doing anything wrong by not paying the taxes. I'm just going to follow the rules that are out there. But it does allow us to take all this hard-earned cash that we got to create and then put it back into this system where I'm going to play the game where at the end of the day, I'm going to own hard assets. I know this machine, this lending machine and this money printing government machine and this fractional reserve banking lending machine, they're just going to create more paper dollars that are going to go all around, but they're going to chase the same good pieces of real estate everywhere. So everywhere you look, when you're flying over all these different billions and trillions of dollars of real estate, because all this paper is chasing good assets, good, solid, fixed assets. So I'm going to play the game where I'm going to take this paper that's going to keep losing value and I'm going to put it in good, solid things. And as long as I can continue to hold these things and I don't put me and myself and my family and our investors in bad situations, that's always going to work. And that's the basics of the game.
It's a beautiful thing. It was said perfectly and it hit home to me. And what it did is it just, it's always good to continually just to make sure it's like it sticks in your brain constantly, like this is why we're doing it, it's because of this. And then and then you forget sometimes about those wins. Like we don't talk about how much money we saved in taxes, or you don't talk about some of those things and you don't hear about some of those things. So it's really good. And then you broke it down into a macro and then a micro kind of look to it.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening to Finding Your Edge.